Meeting is being recorded.
Hello everybody, so this is the first of two videos which together are meant to cover our capital budgeting chapter. So if you remember, in capital budgeting we have a corporation which is simply trying to decide whether or not it wants to make a long-term investment. And as we discussed before the break, the most typical way in which this is done is in two steps. First, we need to project incremental unlevered free cash flows to the firm, and then we need to discount those cash flows using WACC. And as long as the present value of those cash flows is higher than the acquisition cost of the project, the investment required to implement the project, then this is a project that has a positive NPV. If it has a positive NPV, the way to think about this is it creates value for our shareholders, and therefore the right decision is in fact to make the project. So this is what we're going to illustrate today, and we're going to do so by using an example as usual. And the specific example we're going to use is going to come from my webpage, if I can get there. Here we go. Web page. As usual, you go to teaching. The case we're going to do is over here. It's called investing in an injection plant. If you have not read the case yet, and case is a big word here, it's only a page and a half. Please pause this video right now and read the case. Otherwise, it's going to be a little bit difficult to follow what I'm about to show you. So this is it. So the idea, the case is about whether or not we should build a plant to serve a particular market, to sell basically plastic containers to a market. And the question is whether or not that's a positive NPV thing to do. And so we're going to go through those calculations. And so this is a traditional DCF exercise, and for that we're going to use, as usual, Excel. So I'm going to open a brand new Excel over here. Okay, so the way to think about DCF is it's just a map. It's a map from assumptions, a lot of assumptions, to a bottom line number, which is the NPV of the project. So of course, the work of coming up with those assumptions is very difficult. All those assumptions are, for the most part, forecasts. They involve things that we can only predict as best we can. And as you will see here in this example, there are a lot of examples. So this is why I say all the time that I have nothing but admiration for the people who do this for a living. I mean, it takes a lot of work to come up with all those forecasts. It also takes a lot of courage to stand in front of people and defend those forecasts, and it's really, really hard work. Now, of course, the case we're going to look at is meant to be pedagogical, so it's not nearly as difficult as what people have to do in reality, but it's also meant to be semi realistic, and in two ways here. First of all, you're going to see that we are going to have to do quite a bit of tedious algebra to get to the bottom line number, and that's of course always the case in DCF. But it's also realistic because this actually was inspired by conversations that I've had with students who, when they come back from their interviews in finance, they often share with me some of the exercises that they have to do, and this is a very, very typical exercise that employers ask you to do to show that first of all you understand finance, but also that you're good with Excel and you can perform those computations relatively quickly. Okay, but there we go. So like I said, DCF is simply a map from assumptions to NPV. So off we go. We're going to start by listing our assumptions. And as I said, there's going to be many of them. First of all, we have to build that plant according to the case. In life, of course, we would have options. We could also rent the facility. We do not have to develop it. We do not have to build it. And another standard capital budgeting question is, should I buy or should I rent? And time permitting, we'll talk about that one in a moment. But here we're assuming that we've decided that we're going to build this plant, and it's going to come at a cost. So this is my development cost. And here, according to the case, it's going to take $6 million to build the facility. Of course, I'm going to want to format my numbers really nicely. So here, what I'm going to do is I'm going to just take the entire uh, tab, the entire space that I'm using, and I'm going to format everything right away as number with 2 decimals and separators. So sometimes we will want to adjust this format, but most of my numbers are going to come with 2 decimals and a comma separator. So just so I don't have to stop to format everything all the time, I'm just going to format the entire space that we're going to use. So there we go. And so now my development cost shows as a nice number with 2 decimals. And so again, the development cost is $6 million. One thing to do always in a DCF exercise like this is to break down the development cost into its 2 essential pieces, which is land and structure. So plant, just like any real estate object, is going to be a bundle. It's going to bundle a structure, a physical structure, and land. And the reason why we need to separate them is that those two are not going to depreciate at the same rate at all. In fact, by assumption, legally, land lives forever, so its useful life is infinite, and therefore I do not get to depreciate land, whereas the structure is going to be assumed to have a finite life. Now, the typical breakdown, this is the one that the IRS will let you do without any questions, is to assume that land is 20% of the development cost, and this is exactly what's happening in this particular case. So 20% of 6 million, which is 1.2 million, is the land, and that's in dollars, and the rest is going to be structure. So there we go. So we have our development cost broken down into its depreciable part and its non-depreciable part. In addition to a building, we also need machines. So we're going to have some equipment cost. And so we're going to have to buy some machine right away. And it also says that we're going to have to buy more machines in year 1. In year 0, by assumption, the investment in machines is $1.5 million. In year 1, it is $1 million. All everything in dollars. Very good. So this is our investment. Those investments are going to depreciate, and so now we have to decide how are we going to depreciate those investments. So I want to remind you, of course, that we do not care about depreciation per se. Depreciation is a non-cash expense, and therefore it has no direct impact on cash flows. However, depreciation is a tax deduction. And of course, a tax deduction has an impact on my cash flows. And for that reason, I have to keep track of depreciation. Okay, so we're going to assume, just like it says to do in the case, that our various investments have different useful lives. The structure, if I could spell, the structure has a useful life of 39 years, and the equipment has a useful life of 12 years. So 39 years for a manufacturing facility is the typical schedule according to the IRS. Typical real estate depreciates at a faster rate according to the IRS, but for manufacturing, 39 years is the normal numbers. In addition, the standard assumption is that depreciation is going to be linear. In other words, every year I'm going to get, in terms of a depreciation deduction, 4.8 million divided by 39. We'll come back to that in a moment. Okay, very good. Now we have a building and we have some machines, and the goal is going to be producing at capacity as soon as possible. And the case tells us exactly what our production capacity is going to be. First of all, I'm going to reach in time a maximum capacity of 1 million units. So the most containers, the highest number of container I can possibly produce in 1 year is 1 million according to the case, but it's going to take a moment to ramp up to that maximum capacity. And in year one, for instance, by assumption, the capacity is going to be 50%. In year two, capacity, oops, capacity is going to be 75%. So these are examples of numbers that I do have to reformat as percent, since that's what they are. So here we go. And after that, starting in year three, we will be at maximum capacity by assumption. Good. Now we have a building, we have our machines, but there are still going to be other costs associated with producing our containers. And as usual, production costs are going to come in two types. First, there's going to be a fixed cost. So this is the cost that you have to incur even before any unit is produced. And in particular, that cost is going to be independent of the number of units that you're going to produce in a particular year. So that's going to be fixed. And by assumption, it is $1 million in this case. That's the fixed cost. There is also a variable cost. So this is the additional cost you're going to incur every time you choose to produce one more unit, and that is by assumption $5 per unit. That's my variable cost, and both are going to grow in time. There's going to be inflation throughout this case, and the relevant inflation rate for my costs, my production costs, is going to be 2%, another number that I have to format as a percent. This is yearly growth, not yearly growth. Okay, very good. So those are my production, my manufacturing costs, but other costs I'm going to incur are going to be administrative. So I'm going to have some SG&A here in order to operate this plant. I'm going to need some support from headquarters. So HR, marketing, uh, basic management. And so here the SG&A cost by assumption is going to be 2% of sales. And this guy is a percent. Very good. Um, okay, continuing after this brief pause here. So far we have our building, we have our machines, we have our production costs, and the other thing I'm going to need to produce is going to be some working capital. I need to have some cash around in order to produce. And so in particular, one thing I'm going to need according to the case are inventories. So this is one place where the case is not quite as realistic as it should be. The only inventory it mentions is a finished good or final good inventory. Of course, in life, you would also have a raw material inventory. You would also have an intermediate good inventory. And we're here for simplicity, not worrying about those. I do want to have inventories in there because inventory math in DCF is probably the trickiest part of the whole exercise. So we do want to get familiar with this, but we're going to assume, just like it says in the case, only that we only need a final good inventory. Okay, very good. So by assumption, my final good inventory every year is going to be 5% of sales. So in order to sell, I need to have, and to support the terms I'm giving my customers, in particular the delivery terms, I need to have 5% of sales in final good inventory. Very good. Other liquidity that I'm going to need is going to be accounts receivables. So I'm going to give standard terms to my customers and I need to finance that. And by assumption, this is going to be 10% of sales. So I have to give financing to my customers, but on the other hand, I am getting financing from my suppliers. So if I look at my payables, I'm also going to get a delay in terms of when I have to pay my suppliers, and by assumption, looking at the case, this is going to be 10% of variable cost. Okay, let me format those properly. Very good. So this is my working capital. So at this point, what we have is all our costs, production costs, and we also have all the assumptions we need to calculate our investment needs. Now we need a marketing forecast. So we need a market projection. I need a forecast as to how much I'm going to be able to sell. And the way this is done, always in practice, is we begin by talking about potential sales. In other words, assuming that production is not an issue, assuming I can produce as much as I want, what is the market going to be able to absorb? And so this is what we call potential sales. And in year one, by assumption, according to the case, my potential sales are going to be 850,000 units. Those potential sales are going to grow from year to year. So the yearly growth rate of those potential sales is going to be 4% according to the case. Next, I need also to forecast what unit price I'm going to be able to charge my customers. And here again, we're going to start in year one. And by assumption, in year one, I can charge $10 per unit. Very good. And that too is going to grow. And it's going to grow by 1%. Let me format my percent properly. So those are percent. Excellent. So this is going to enable us to figure how much we can sell as long as production is not an issue. Very good. That's what the market can support, and that's information that we need. Okay, so far with this, we will be able to compute all the incremental cash flows we're going to generate from operations. But of course, at some point, I'm going to have to truncate the analysis, either because I am literally planning to sell the facility or simply because I cannot measure an infinity of cash flows. I mean, I can, of course, that would be a problem in and of itself. But in addition, the idea of forecasting what cash flows are going to be 25 years or 30 years down the road is silly. This is just not going to be possible. So instead, whether or not we are actually planning to sell the facility, we're going to truncate the analysis by assuming that at the end of 5 years or at the end of 10 years in this case, we're going to sell the facility, and that's going to generate reversion cash flows. That transaction, hypothetical or real transaction, is going to generate cash flows that I can distribute to my debt and my equity holders. And so the first thing I'm going to sell is the facility itself, and it's going to have a net sale price of, in this case, in 10 years, $6.5 million. Next, I'm going to sell my equipment, my machine, and here the assumption is that that's going to go at book or recorded historical values. My inventory is also something that is valuable for people that will purchase my establishment here. That's going to sell for market. That's certainly the assumption that makes the most sense, since these are finished products. We should be able to sell them at market. And the other thing we're going to sell are our net receivables. When we sell this transaction, I have all that money that is owed to me from customers. That has value. Anybody buying this business would be willing to pay something for that. And here we're going to assume that net receivables are going to sell for book. Very good. Finally, at long last, we have all our assumptions. So now that we have listed our assumptions, we need to turn those assumptions into unlevered free cash flows to the firm. So for that, we're going to need to create a pro forma table. So the first thing that we need is to record the fact that we're going to do this over 10 years. So this is 0, 1, 2, 3. We're going to drag this to 10. There we go. This decimal format really does not make any sense for years, so I'm going to remove the comma separators and remove all the decimals. All of that is good. Let me try to make it look better by making it bold, and then I'm going to put maybe a little border that will make it look nice. So I'm looking for a border at the bottom, and maybe I'm going to make it thick, a nice border, and that should do. Okay, very good. So here we go. We have something that's beginning to look like a pro forma. Okay, so the key part of this pro forma is going to be calculating our production plan. Once we have our production plan, that is to say, once we know how many units we're going to produce and how many units we're going to keep in inventory, and therefore how many units we're going to sell, then I'm going to be able to calculate everything else. I can calculate how much it's going to cost me to produce those units, but I can also calculate how much operating income those units are going to generate. This is going to give me my EBITDA, and then in turn it's going to give me my EBIT, and I will be done. So this is the most important part, and in some sense, in this case, the most difficult part of this pro forma. So we're going to begin, as I said, by looking at the very top, which is my potential sales. And that I'm going to call from now on, I'm going to use the acronym PS. Okay, so potential sales, again, is what the market is going to be able to absorb from this particular facility once I build it. It is not clear whether or not I'm going to be able to meet those sales, but this is in some sense the most I'm going to be able to sell. So it's like the best case scenario. So what are my potential sales? By assumption, in year one, they are 850,000 units. And then also by assumption, this is something that is going to grow at a rate of 4% F4. Very good. So if I'm so lucky as to be able to produce and deliver on everything the market is able to handle, these are the sales that I'm going to be able to make. But of course, in order to support those sales, as we've discussed already, there is an inventory requirement. So I need to keep track of the inventory requirement at potential. So that is to say, if I am so lucky, if I'm lucky enough that I get to sell at potential, I need to uh, have the inventories to match to support those sales. So this is what we're going to call RIPS, required inventory at potential sales. This is something that's very easy to compute because I have assumptions about this. If I sell at my potential sale, I need to keep a certain fraction of my sales in inventory, and that's what we call the inventory ratio, which should be over here somewhere. Final inventory 5% of sale. Here we go. F4. Okay. Good. These are the units that I have to keep around if I'm going to sell at inventory. Okay. So now we're beginning to do some inventory math. And so this is normally the time when I would go to the board, since obviously going to the board virtually is difficult to do. What I've done instead is I have typed up the what I would normally put on the board, and this is what I call extra notes here on my webpage. If you do not see this bullet point on your browser, what you want to do is reload, 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 and reload again. If that's not enough, you want to clear your browsing history and then reload again. And that should do it. That should bring up those extra notes. If you still cannot see my extra notes, then you can email me and I will email those notes to you. But here we go. Let's open those extra notes and let me make it bigger so that you will all be able to see it. And so this is the first part of the calculation that I've done so far. All I've written is that the required inventory at potential sales is equal to potential sales times the inventory ratio, which is 5% in our case. Okay, so now what I need to calculate is, let's assume, or let me calculate how much I would need to produce in order to sell at potential. So in order to sell at potential, I have to have enough units to sell at potential and then to support the inventory required at potential. But of course, at least starting in year 2, I already start with some inventory. I'm going to have something that we call my starting inventory, which is whatever I finished with in terms of inventory from the year before. I'm going to carry it into this year. And so this is, of course, finished units that I already have around, and I'm going to be able to use that to satisfy my sales this year. So if I want to calculate production needed to sell at potential, which I'm going to shorten to PNP, production needed for potential. So what do I need? I need to meet my potential sales. I need my required inventory to meet potential sales. So this is all that I need to produce. And I need to, but at the same time, I have all that starting inventory, which I get to use. So going back to my Excel, if I want to calculate production needed to sell at potential, and I'm going to call that P and P, what this is going to be, it's always going to be potential sales plus required inventory at potential sale, and then there would be a minus starting inventory, but of course, in year 1, I do not have any starting inventory, so I'm just going to write -0 here, just for emphasis, since I do not have a starting inventory. Very good. So I'm going to just take care of year 1 for now, since I need to go all the way down to starting inventory in order to begin to work on year 2 to compute PNP for year 2. So let's go back to our notes for a moment. Okay, so production needed to sell at potential, we've already computed, that's PNP. I wish I could produce that. But of course, I'm constrained by capacity. So what are my unit produced going to be? They are going to be the smaller of capacity and production needed to meet potential sales. Okay, so having computed PNP, knowing capacity, I'm going to be able to compute what my unit produced are going to be. Now, it is very important to note that there is an assumption here, which is in bold. The assumption is that I never produce more than what I need to meet my potential sales. So it sounds kind of obvious, but it's not. It is possible that I would have an incentive to hoard, to produce over and beyond what I need to satisfy the market in order to have more inventory in place down the road. And there could be several reasons for this. One, it could be that I expect capacity to be a binding constraint down the road. I know I'm going to be produce constrained. So today I just want to ramp up production and I want to start hoarding inventories. We will argue soon that that is not the case in our case. No incentive to do that. The other reason I may want to sell above I may want to produce above the production needed for potential is Maybe this year, for whatever reason, my costs are low. So a typical case of that is assume that I have idle workers. I have workers which I'm already paying, but somehow I'm not finding enough production to keep them busy. Given that the marginal cost of putting those workers to work rather than leaving them to not producing is zero, that's going to give me an incentive to accumulate final goods, which I may want to take advantage of. Again, given the cost structure, in our case, we will be able to make the case that I do not have any incentive to hoard inventories in this particular case. And since that's the case, we get this expression that unit produced has to be the smaller of either capacity, which is the most I can do, and the production needed to meet potential. Okay, so what I need for this is my capacity. So what is my capacity? My capacity, by assumption, is 1 million units, F4 times 50% in year one, F4. And since I'm here, I might as well finish my capacity calculation. In year two, likewise, it's going to be $1 million times 75%. 4. And then finally, in year 3, we're going to reach maximum capacity, which is 1,000,004. And all the way. And of course, after that, in year 4, it is the same as year 3 and all the way to year 10. Very good. So now we have our capacity, and so we can now calculate under the no hoarding assumption what we're going to be able to produce, and that has a name. This is in an acronym. This is called UP, and UP is equal to the minimum of what I need to produce at potential, to sell at potential. I'm sorry, and capacity. Very good. So it's the smaller of the two. So now I know what I'm going to produce. Of course, now I have two numbers that I have left to compute. One is how much am I going to sell? And two is how much am I going to keep in inventory? So let's go back to our notes. And the way to figure out inventory and units sold is going to be like follows. First of all, some very simple accounting. If I want to know what my ending inventory is at the end of a given year, all I have to write is that my ending inventory is going to be my starting inventory plus what I'm going to produce for the year and minus the units that I'm going to sell. So this is just basic accounting. But at the same time, as long as we're willing to make this no hoarding assumption, we also know that my ending inventory is exactly and no more than what I need to support my sales. But what do I need to support my sales? It is units sold times the inventory ratio. So what I'm going to do now is I'm going to take this expression for ending inventory. In other words, US times IR, I'm going to put it here. I'm going to do a little bit of algebra. And what it is going to tell me is that units sold are just going to be my unit produced, I'm sorry, plus my starting inventory divided by 1 plus the inventory ratio. So here, I'm going to be able to write units sold, which is US. And what is that going to be? Unit sold is going to be unit produced plus my starting inventory, which here is 0 because when I begin I do not have any inventory around, but I'm still going to write plus 0 for emphasis divided by 1 plus the inventory ratio, which my inventory ratio is, where is my working capital? Right here, 5% of sale, F4. Very good. And so now I'm just going to take a moment to make sure that I have not messed this up. And yes, my unit sold are going to be this number here. And then I'm going to next write my inventory. And here, this is going to be my ending inventory. So this is when I finish the year, how much inventory do I have around? Well, by assumption, and this is the definition, by the way, of what we mean by an inventory ratio. What we mean by an inventory ratio is if you have sold a certain number in the year, at the end of the year, you have to have 5% of that number in inventory. So here, um, again, under the no hoarding assumption, my inventory is going to be my units sold times that same 5% ratio. Very good. Just checking that my formula is correct and this makes sense. Excellent. So this particular formula here, I get to drag all the way because this is always going to be true, that units sold is going to be the minimum of capacity and production needed to support potential. Another one that I get to drag because this one is very simple is this one. The other two I cannot drag quite yet because you remember we have those zeros in there, but now we're going to have some starting inventory. So for instance, let's take production needed to sell at potential. So production needed to sell at potential is always equal to my potential sales plus the required inventory if I want to support potential sales. But now I do have some starting inventory, and namely starting inventory at the start of year 2 is just what I ended year 1 with. So here we're going to go with minus ending inventory. Okay. So this is, I just want to switch again to my notes. What we are using here is this formula here. So this is potential sales plus required investment to support potential sales minus starting inventory. Very good. Enter. Then we can track this all the way to year 10. And what else do we need? Units sold is just going to be according to our formula. This is, so let's go back to our formula for units sold. It is unit produced plus starting inventory divided by 1 plus the inventory ratio. So let's use that formula. This is unit produced plus starting inventory, which is the ending inventory from the previous year, divided by 1 plus the inventory ratio, which is 5%, F4. And off we go. I'm going to drag that all the way to the end, and I'm going to take a moment once again to make sure that I have not messed anything up. I just want to make sure that this matches the calculations that I had done. Very good. So this looks excellent. Miraculously, I haven't made any mistake yet. I'm sure they're coming. Very good. So we're going to stop fairly soon here since this is quite enough for one video. But before, since we've worked so hard to arrive at our production plan for this entire projection, we might as well take a moment to look at it and maybe make sure that what we're doing here makes sense. So let me, for instance, look at production needed to sell at potential, capacity, and unit produce. So I'm going to take those three objects. I'm going to push control and I'm going to take the corresponding data over 10 years. There we go. Then I'm going to insert a line chart, this guy, and I'm going to make my chart as big as possible. Okay, so the blue line here on this chart is the production that I need to carry out in order to sell at potential. And again, the numbers in this case are such that if I can, I want to sell at potential. The orange line is capacity. So there is this ramp up period. It takes me 2 years to reach maximum capacity. And the result of this ramping up is that initially I cannot produce and therefore sell at potential. So that means that my unit produced are going to be constrained by capacity, and unit produced is shown in gray here. But then in year 3, once I reach my maximum capacity, my capacity is above the production that I need to meet my potential. So that means that I am going to sell at potential, and in particular, unit produced are going to be just the production needed to sell at potential, again, under the no hoarding assumption, which holds here. But eventually, of course, the blue line is going to catch up to capacity. There is inflation both in the size of the market and in my unit price. Well, actually, here all that matters is the size of the market, not the unit price yet, because we're doing everything in terms of quantity. So the size of the market is getting bigger, and in particular, potential sales are going to outpace my capacity. And so once again, capacity is going to be constrained. So you can imagine that this is going to happen every time you build a facility. There's always going to be a ramp up period. Capacity is always going to be the binding constraint initially. And also, as long as you've calibrated your plant properly, eventually the market is going to outpace your capacity. So what I mean here is that if that was not the case, let's assume that you had excess capacity throughout the investment period, then this probably would not be the profitable thing to do. Why would you have this excess capacity for 10 years? It makes sense to basically target some needed capacity in the middle of the exercise. So good. So all of this makes sense, which bodes well for our numbers. And the final thing I'm going to do is I'm going to talk about the no hoarding assumption really quick. So what happens here, and we've already looked at it graphically, but I'm going to say this again, is in year 1 and in year 2, I would love to produce enough to meet my potential sales, but I can't. I can't because I'm constrained by capacity. So I'm doing the most I can. There is no more that I could produce. Once I get to year 3, everything is well. Production needed to sell at potential is exactly what I'm going to produce, and that's because I'm at maximum capacity and everything is good. So that means that, for instance, here in principle, I may want to produce in such a way as to hoard some inventory in case capacity was going to be a problem down the road, but I can't. And then starting in year 3, I'm already able to meet potential. So that means that I do not have any additional need to go above production. All right, so I'm going to stop here for this first video, and then I'll pick up right here in my next video.